In today's video, we are doing a deep dive into SaaS accounting, covering the complete business flow, end-to-end accounting treatment, real-world journal entries, financial statement impact, common errors, and the kind of interview questions that companies actually ask. Whether you are preparing for a job interview, working in finance, or just building your accounting foundation, stay with us because this video covers everything. In this section, we will go through all the key concepts of business understanding in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Software as a service, SaaS, provides software over the internet, eliminating the need for physical installation. This industry has grown rapidly, with major players like Zoho, Salesforce, and Microsoft. The SaaS market is global, with significant operations in India, contributing to its strong IT sector. Understanding SaaS helps in comprehending its impact on global software delivery and how it democratizes access to advanced technology across different sectors. Zoho Corporation, like other SaaS companies, earns primarily through subscription fees. These fees provide a steady revenue stream, unlike traditional software sales, which are one-off. The recurring nature of subscriptions aids in forecasting and financial stability. Major cost drivers include cloud infrastructure and continuous R&D to update and improve software offerings. This model supports scalability, allowing companies to serve more customers without a proportionate increase in costs. In SaaS companies like Zoho, the finance department manages billing and revenue recognition, crucial for accurate financial reporting. Operations ensure smooth service delivery, while procurement handles vendor relationships for infrastructure needs. Legal ensures compliance with software licensing and data protection laws. Each department contributes to accurate accounting, ensuring regulatory compliance and operational efficiency. Their roles are interconnected, impacting overall financial health and strategic decision-making. In a SaaS company like Zoho, the workflow begins with product development and moves to marketing strategies. Sales teams handle customer acquisition, followed by service delivery and customer support. Finance teams manage billing and revenue recognition. This seamless flow ensures product innovation, market penetration, customer satisfaction, and financial accuracy. Each step is crucial for maintaining competitive advantage and operational efficiency in a rapidly evolving industry. SaaS companies engage with various stakeholders, including clients who seek reliable software solutions and vendors providing necessary infrastructure. Governments and regulators require compliance with data protection laws, impacting accounting practices. Banks facilitate financial operations, and investors demand transparent financial reporting. Understanding these relationships helps in navigating the complexities of SaaS accounting, ensuring robust stakeholder management and strategic alignment with regulatory frameworks. SaaS accounting must address unique challenges such as the working capital cycle, involving upfront costs with deferred revenue recognition. Contract complexities arise from varying billing cycles and service agreements. Regulatory requirements demand adherence to international standards like GDPR, affecting data handling and financial practices. These challenges necessitate specialized accounting approaches, ensuring compliance, accuracy, and efficiency in financial management within the SaaS landscape. Accounting for SaaS differs from traditional businesses due to its recurring revenue model and the need for deferred revenue recognition. This requires tracking subscriptions and renewals meticulously. Revenue recognition principles must align with service delivery, impacting financial statements. These nuances ensure that financial reports accurately reflect the company's financial health and operational performance, crucial for investor confidence and strategic planning in the rapidly growing SaaS industry. In SaaS companies like Zoho, the finance team typically manages accounting entries, triggered by events like subscription sales or contract renewals. These entries ensure compliance with revenue recognition norms and financial accuracy. Proper timing and classification of entries are crucial for reflecting true financial health. This process involves close collaboration with sales and legal teams to ensure all financial transactions are recorded accurately and in compliance with regulations. In this section, we explore the end-to-end accounting process for a SaaS company like Zoho Corporation. Understanding these steps helps ensure accurate financial reporting and compliance. Each stage in the process builds on the previous, providing a comprehensive view of how SaaS transactions flow from inception to completion. Let's delve into each part of this lifecycle, examining key activities, responsible parties, and potential pitfalls. The SaaS lifecycle begins with a customer placing an order for a subscription service. Sales departments often use CRM systems to capture order details, ensuring customer needs align with service offerings. Accurate data entry at this stage is crucial to avoid downstream billing errors. The order document becomes the first accounting trigger, initiating the revenue recognition process. Mistakes here, like incorrect service terms, can disrupt the entire billing cycle. Once an order is placed, it often requires internal approval to ensure compliance with pricing and discount policies. The legal department drafts the service contract, aligning terms with the customer order. This step is critical because it formalizes the agreement and impacts future revenue recognition. Errors in contract terms can lead to disputes and financial restatements. Systems like ERP help track these approvals and documentations efficiently. Advance payments are common in SaaS to secure cash flow before service delivery. The finance team records these as liabilities until the service is delivered. Payments are processed through various systems, such as payment gateways or direct bank deposits. Misallocation of these funds can lead to incorrect financial statements, making accurate reconciliation essential. Keeping track of these advances ensures that revenue is recognized appropriately over the subscription period. Service delivery marks the transition from liability to revenue. The operations team delivers the SaaS products, confirming that customers have access and functionality. Revenue is recognized over the subscription period, following specific accounting standards like ASC 606. This process ensures that revenue is reported only once the service is delivered. Errors in recognizing revenue prematurely can lead to non-compliance and financial restatement issues. Invoicing is crucial for cash flow and customer relationship management. The billing department generates invoices, often leveraging automated billing systems to ensure accuracy and efficiency. Timely and accurate invoicing ensures the company gets paid on time. Errors here can lead to customer dissatisfaction and delayed payments, impacting cash flow. Automation helps reduce manual errors and allows for seamless updates to billing terms as services evolve. Payment collection is managed by the finance team, who ensure funds are received and correctly applied. They use accounting software to match payments with outstanding invoices, keeping financial records accurate. Reconciliation involves verifying that the bank statements align with internal records. Payment discrepancies can result from misapplied payments or bank errors, requiring timely resolution to maintain financial integrity. Effective reconciliation supports cash flow management and financial reporting accuracy. At the period's end, financial close consolidates accounting records for reporting. The finance team reviews all transactions, ensuring compliance with accounting standards. Accurate closing allows for preparing financial statements, which inform stakeholders about the company's performance. Errors during close can lead to inaccurate reports, impacting investor confidence and regulatory compliance. Timely close processes are essential for maintaining the integrity and reliability of financial data. This flow diagram summarizes the entire SaaS accounting process, illustrating each stage's transition. Starting from the customer order and ending with financial reporting, each step involves specific departments and systems. This visual representation helps identify key dependencies and workflow efficiencies. Understanding this flow is vital for optimizing processes and ensuring accurate financial management. It also aids in identifying potential bottlenecks that could affect overall operations. In this section, we will go through all the key concepts of accounting concepts in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Revenue recognition is a fundamental accounting concept that determines when a company records its sales revenue. This is particularly important for SaaS companies like Zoho Corporation, which operate on subscription-based models, offering services over time rather than delivering a product at a single point of sale. The accounting standards ASC 606 and International Financial Reporting Standards 15 govern revenue recognition, emphasizing that revenue should be recognized over the service period to match the delivery of services. For example, If Zoho signs a one-year contract, they must recognize revenue monthly, rather than when cash is received. This approach differs from traditional accounting, where revenue might be recognized at the point of sale. In SaaS, correct revenue recognition ensures financial statements accurately reflect the company's performance and cash flow. Deferred revenue is a liability that reflects payments received for services yet to be delivered. In the SaaS industry, companies like Zoho often receive upfront payments for annual subscriptions, creating deferred revenue until the service is provided. According to ASC 606 and International Financial Reporting Standards 15, deferred revenue should be recognized as actual revenue over the life of the contract. For instance, if Zoho receives $120,000 for a one-year service, it must recognize $10,000 each month. This treatment contrasts with traditional accounting, where revenue might be recognized immediately upon cash receipt. Understanding deferred revenue is critical for SaaS companies to accurately reflect their financial obligations and future service commitments. Cost allocation involves distributing costs across various services or products, ensuring each service bears its fair share of expenses. For SaaS companies like Zoho, where development, marketing, and maintenance costs extend over multiple periods or services, cost allocation is crucial. Although not directly governed by a specific accounting standard, cost accounting principles provide guidance on how to allocate these costs effectively. By allocating costs accurately, Zoho can determine the profitability of each service or product line, ensuring financial statements reflect true performance. In contrast to general accounting, SaaS cost allocation must consider ongoing service delivery and continuous product development, making it a more dynamic process. Contract accounting deals with the financial reporting of contractual obligations between a business and its customers. In SaaS, where contracts often include multiple deliverables like software licenses, support, and updates, understanding contract accounting is essential. ASC 606 and International Financial Reporting Standards 15 provide guidance on recognizing revenue from contracts with customers, focusing on identifying performance obligations and allocating transaction prices accordingly. For example, Zoho might have a contract that includes software access and customer support. Revenue must be recognized separately for each obligation as they are fulfilled. This differs from general accounting, where contracts might not include complex ongoing obligations. For SaaS, grasping contract accounting ensures accurate revenue recognition and compliance with financial reporting standards. Expense recognition is the process of determining when to record expenses in financial statements. For SaaS companies like Zoho, which incur ongoing development, marketing, and operational costs, understanding expense recognition is key. Governed by the matching principle, expenses should be recorded in the same period as the revenue they help generate. For example, if Zoho incurs server costs to support a subscription service, those costs should be matched with the revenue from that service period. This concept ensures financial statements present a true picture of profitability, differing from traditional accounting where expenses might be recorded as incurred without directly matching related revenue. In SaaS, precise expense recognition supports accurate financial analysis and decision-making. Foreign currency transactions involve the accounting treatment of transactions in currencies other than the entity's functional currency. For SaaS companies like Zoho, which serve a global customer base, managing foreign currency transactions is crucial. ASC 830 and International Financial Reporting Standards 21 provide guidelines for translating foreign currency transactions into the company's functional currency. For instance, Zoho might receive payments in euros, which must be converted to USD for financial reporting. This differs from general accounting, where domestic transactions dominate. In SaaS, accurately handling foreign currency transactions ensures compliance with international accounting standards and provides clarity on financial performance across different markets. Segment reporting involves providing detailed financial information on different business segments within a company. For SaaS businesses like Zoho, which offer a range of products and services, segment reporting is vital. ASC 280 and International Financial Reporting Standards 8 require companies to disclose revenue, profit, and other key metrics for each segment, enhancing transparency and enabling stakeholders to assess performance accurately. For example, Zoho might report separate data for its CRM and email services. This differs from general accounting, where a less detailed approach might suffice. In SaaS, Segment reporting helps investors and managers understand which areas drive growth and profitability, aiding strategic decision-making. Provisions and contingencies relate to accounting for potential liabilities that may arise in the future. For SaaS companies like Zoho, which might face service-related obligations or legal disputes, understanding these concepts is essential. ASC 450 and IAS 37 outline the requirements for recognizing provisions and disclosures of contingent liabilities, emphasizing the need for estimation and transparency. For instance, Zoho may set aside a provision for potential service failures requiring compensation. This approach contrasts with general accounting, where contingencies may be less prominent. In SaaS, accurate provisioning is crucial to reflect potential risks and ensure stakeholders are informed about uncertainties affecting the company. Financial instruments encompass contracts resulting in financial assets or liabilities, such as investments or loans. For SaaS companies like Zoho, which might engage in various investment activities to manage cash reserves, understanding financial instruments is crucial. ASC 825 and International Financial Reporting Standards 9 guide the recognition, measurement, and disclosure of these instruments, emphasizing fair value measurement. For instance, if Zoho invests in marketable securities, they must report these at fair value on financial statements. This differs from traditional accounting, where such investments might be minimal. In SaaS, knowledge of financial instruments supports effective financial management and strategic investment decisions. In this section, we will go through all the key concepts of journal entries in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Zoho Corporation issues shares to raise initial capital, which is crucial for funding startup operations. The company receives cash from investors, increasing the bank account. By crediting equity share capital, Zoho acknowledges the ownership stake investors have acquired. This transaction is foundational, as it establishes Zoho's financial base for future operations. Purchasing software infrastructure is a strategic investment for Zoho, laying the groundwork for their SaaS offerings. By debiting intangible assets, Zoho records this long-term investment that will be used to generate future revenue. The bank account is credited to reflect the cash outflow. This transaction ensures the company is equipped with the necessary technology to operate effectively. Hiring skilled technical staff is vital for Zoho to innovate and maintain high-quality SaaS products. The salary expenses are recorded by debiting salaries and wages, indicating a business cost that supports revenue generation. The corresponding credit to bank reflects payment to employees. This investment in human capital is essential for sustaining product development and customer support. Generating revenue through subscription sales is a core aspect of Zoho's business model. The debit to bank reflects cash inflows from clients who purchased the software services. Crediting revenue from operations shows the income earned from providing these services. This transaction signals the company's ability to convert its investments in technology and talent into tangible financial returns. Receiving customer payments is crucial for maintaining cash flow in Zoho's operations. The bank account is debited to reflect the cash inflow, while trade receivables is credited, indicating a reduction in money owed to the company. This transaction enhances Zoho's liquidity, ensuring they have the necessary funds to cover operational expenses and invest in growth opportunities. Paying office rent is a regular operational expense for Zoho and essential for maintaining a physical space for their team. Debiting rent expense captures this cost of doing business, necessary for facilitating daily operations. The credit to bank reflects the depletion of cash resources. Such expenses are critical for supporting the infrastructure needed to manage and grow their SaaS offerings. Recording depreciation is essential for capturing the reduction in value of Zoho's software infrastructure over time. By debiting depreciation expense, the company recognizes the cost associated with asset usage. Crediting accumulated depreciation helps track the total depreciation over the asset's life. This accounting process ensures accurate financial statements, reflecting asset consumption and aiding in future investment decisions. Creating a provision for income taxes allows Zoho to anticipate and plan for their tax liabilities. By debiting income tax expense, they acknowledge the cost of taxes incurred through profitable operations. The credit to provision for income tax represents a future obligation, ensuring funds are set aside to meet this liability. This proactive approach supports financial stability and compliance with statutory requirements. Declaring dividends reflects Zoho's commitment to sharing profits with its shareholders, reinforcing investor trust. The debit to retained earnings indicates the distribution of past profits. By crediting dividends payable, Zoho records the liability to pay shareholders. This decision balances rewarding investors while maintaining sufficient reinvestment capital for future growth, highlighting sound financial management. Paying out dividends is the final step in the dividend declaration process, fulfilling Zoho's obligation to its shareholders. The debit to dividends payable indicates settling the liability, while the credit to bank reflects the cash outflow. This transaction demonstrates Zoho's ability to generate sufficient profit to reward investors, strengthening shareholder relations and enhancing future investment potential. In this section, we will go through all the key concepts of financial statement impact in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. In SaaS companies like Zoho, accounts receivable increase as services are delivered but not yet paid for, reflecting sales on credit. Conversely, deferred revenue rises when cash is received upfront, indicating a liability to deliver services. Cash inflows increase with upfront payments, while prepaid expenses rise as costs like software licenses are paid in advance. These movements reflect the business model's reliance on subscription sales and upfront payments, crucial for cash flow management. In the SaaS industry, non-current assets like intangible assets grow as companies invest in proprietary software development. Property, plant, and equipment increase when physical infrastructure is expanded. Long-term debt rises when companies finance their growth with loans or bonds. Goodwill emerges when acquiring another company for more than its net asset value, reflecting strategic acquisitions to enhance market presence. These investments in financial structures are critical for sustaining competitive advantage and scaling operations. For SaaS companies like Zoho, subscription revenue is a primary income source, credited when services are billed. Service revenue boosts earnings through additional charges like consulting. Direct costs, such as COGS and hosting expenses, rise as they are essential for delivering services. These expenses are debited, impacting gross profit. Monitoring these metrics helps management evaluate the cost-effectiveness of operations and pricing strategies, critical for maintaining profitability in a competitive market. In SaaS, indirect expenses like sales, marketing, and administrative costs are debited, reflecting expenditures to drive growth and maintain operations. EBITDA, a key performance measure, excludes interest, taxes, depreciation, and amortization, offering insight into operational efficiency. Profit before tax reveals profitability before tax obligations. These metrics help stakeholders assess financial health, efficiency, and scalability, guiding strategic decisions in a dynamic technology marketplace. Cash flow statements reveal how SaaS companies like Zoho manage financial resources. Operating cash flow indicates cash generated from core activities, crucial for ongoing operations. Investing cash flow reflects capital allocations toward growth, such as R&D or acquisitions. Financing cash flow shows capital raised through debts or equity, impacting liquidity. Free cash flow, derived from operating and investing activities, measures financial flexibility and capacity to fund future expansion or return capital to investors. Key financial ratios provide deep insights into SaaS performance. The current ratio gauges liquidity, ensuring Zoho can meet short-term obligations. Gross margin measures profitability from core activities, critical for pricing strategies. Churn rate assesses customer retention, vital in subscription models. Customer acquisition cost evaluates marketing efficiency, affecting growth sustainability. Lifetime value forecasts potential revenue from customers, guiding investment in customer relationships. These ratios collectively influence strategic and operational decisions. In this section, we will go through all the key concepts of common errors in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Cut-off errors in SaaS accounting happen when revenue from contracts like those at Zoho Corporation is recorded in the wrong reporting period. This often results from delays in invoicing or contract finalization. Such errors distort financial results, misleading stakeholders about the company's performance. Correct procedures involve ensuring revenue is recognized when services are delivered, aligning financial periods accurately. Auditors detect these errors by reviewing contract terms and checking if the revenue aligns with delivery dates. Deferred revenue misstatements occur when a SaaS company like Zoho improperly accounts for payments received for services not yet delivered. These errors often arise from a lack of proper tracking of service delivery against customer contracts. Misstatements in deferred revenue can lead to incorrect liability figures, impacting the company's financial position. Correct accounting treatment involves regularly adjusting deferred accounts to reflect service delivery progress. Auditors typically identify such errors through contract reviews and matching service delivery with recognized revenue. In SaaS accounting interviews, misunderstanding ASC 606 can be a critical pitfall. ASC 606 outlines a 5-step revenue recognition model, crucial for SaaS companies like Zoho. These steps include identifying contracts and performance obligations, determining transaction prices, and recognizing revenue upon satisfaction of obligations. Candidates often falter by oversimplifying or misapplying these principles. Proper understanding is essential because it ensures accurate revenue recognition and compliance with accounting standards. Interviewers test this knowledge to assess a candidate's readiness to apply complex accounting standards in real-world situations. ERP implementation mistakes in a SaaS environment, such as at Zoho, can cause significant financial inaccuracies. These errors often occur due to inadequate planning or incorrect system configuration. When ERP systems aren't properly set up, it can lead to data entry errors, misaligned financial reporting, and compliance issues. To avoid such pitfalls, thorough planning, testing, and validation of ERP configurations are crucial. Auditors will review system settings and transaction flows to ensure the ERP system supports accurate financial reporting and data integrity. Standard switching errors occur when companies like Zoho inadvertently switch between different accounting standards, such as International Financial Reporting Standards and Generally Accepted Accounting Principles, without making necessary adjustments. This inconsistency can lead to significant financial misstatements, as each standard has its own recognition and measurement criteria. Such errors often occur due to unclear accounting policies or inadequate training. Consistent application of chosen standards is crucial for accurate and reliable financial reporting. Auditors detect these errors by reviewing financial statements for adherence to a single set of standards and checking for proper disclosures of any changes. In this section, we will go through all the key concepts of interview questions in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. In SaaS, revenue is recognized over time as services are provided, aligning with International Financial Reporting Standards 15, which focuses on transferring control to the customer. Zoho, for example, uses subscription models where revenue is recognized monthly or annually as customers access services. This ensures revenue reflects actual service delivery, crucial for accurate financial reporting. Understanding these principles helps ensure compliance with international standards. Deferred revenue, or unearned revenue, arises when payment is received before delivering the service. Zoho would record this as a liability on the balance sheet until the service is provided. For example, if Zoho charges annually for its CRM software, it records the payment as deferred revenue and recognizes it monthly as the service is delivered. This approach ensures alignment between revenue recognition and service delivery. Zoho recognizes expenses in correlation with revenue to match costs with the period of benefit. This involves matching costs like customer acquisition and software updates with revenue from subscriptions, ensuring accurate profitability assessment. For instance, marketing costs incurred to gain subscribers can be capitalized and amortized over the subscription period. This matching principle aligns expenses with related revenue, providing a true picture of financial performance. ASC 606 impacts SaaS companies by introducing the 5-step revenue recognition model, which emphasizes contract identification and performance obligations. For Zoho, this means careful evaluation of service contracts and determining when control is transferred to customers. This could affect how and when revenue is recognized, impacting financial statements and business decisions. Compliance ensures transparency and consistency in financial reporting. Under International Financial Reporting Standards 15, Zoho must allocate transaction price over the contract term, recognizing revenue as services are delivered. For multi-year contracts, this involves identifying performance obligations and recognizing revenue in line with service delivery. This ensures revenue reflects actual service provision rather than cash receipt timing, providing a consistent financial picture. Proper allocation and recognition enhance financial statement accuracy and stakeholder trust. Zoho must adjust the transaction price and reallocate it over the remaining contract period for subscription changes. When a customer upgrades, additional revenue is recognized over the new service period. Conversely, downgrades require contract modification, potentially leading to revenue reversal. This ensures revenue recognition aligns with the revised service terms, maintaining compliance with accounting standards and reflecting accurate service provision. When Zoho receives payment for an annual subscription, it records cash, asset, and deferred revenue liability. The entry is debit cash, credit deferred revenue. As services are provided monthly, Zoho reduces deferred revenue and recognizes earned revenue. For example, if the subscription is $1,200 annually, each month, Zoho debits deferred revenue $100 and credits revenue $100. This ensures financials reflect actual service delivery, adhering to revenue recognition principles. Customer incentives must be factored into the transaction price under International Financial Reporting Standards 15. Zoho should allocate discounts proportionately across performance obligations, adjusting the recognized revenue. For instance, if a customer receives a 10% discount on a $1,000 subscription, Zoho records revenue based on $900. This ensures revenue reflects the actual payment expectation, maintaining alignment with service delivery and enhancing financial reporting accuracy. An ERP system streamlines revenue recognition by automating contract management, performance obligation tracking, and revenue allocation. For Zoho, integrating ERP with its billing system allows real-time updates and compliance with standards like International Financial Reporting Standard 15. This ensures accuracy in revenue reporting by handling complex scenarios such as multi-element arrangements, providing insights for decision-making, and enhancing financial statement reliability. Refunds require adjusting the initially recognized revenue and correcting the financial statements. Zoho must debit revenue and credit cash or accounts payable. For instance, a refund on a $200 subscription means reversing $200 from revenue. This impacts revenue figures and potentially deferred revenue schedules. Proper accounting of refunds ensures transparency and compliance with revenue recognition principles, maintaining stakeholder confidence. Understanding the SaaS business model is crucial, as it relies on recurring revenue through subscriptions. This stabilizes cash flow and enhances long-term profitability. Service delivery through cloud platforms allows flexibility and scalability, which is vital for customer satisfaction. Effective customer acquisition strategies and a focus on reducing churn are key. Additionally, the billing cycle affects revenue recognition, while continuous product updates and robust customer support ensure competitive advantage. Compliance with data privacy regulations is also essential for maintaining customer trust. SaaS accounting requires understanding how to recognize revenue as services are delivered, not just when cash is received. Deferred revenue is a liability reflecting cash received in advance. Expenses must match the period of related revenue to accurately assess profitability. Some development costs can be capitalized, impacting future earnings through amortization. Managing accounts receivable is crucial for cash flow. Monitoring churn rate and key subscription metrics like MRR and ARR is essential for evaluating financial health and sustainability. In preparing for interviews, focus on explaining SaaS-specific concepts, like how revenue recognition differs from traditional sales. Discuss key metrics like MRR and ARR, which are vital for strategic planning. Understand the impact of churn on financial projections and how deferred revenue is treated in financial statements. Be ready to talk about expense management, emphasizing the importance of matching expenses with revenue. Highlight the role of regulatory compliance and the significance of customer lifetime value in sustaining SaaS business models. That is your complete guide to this topic. If this video helped you, please like and share it. It genuinely helps us keep creating content like this. Drop your topic requests in the comments below. Subscribe to CandiMentor for more finance and accounting videos. We will see you in the next one.